Topic begins with an examination of value investing and the reasons why value stocks may generate superior long-term returns. Value investing focuses on purchasing securities that appear undervalued relative to their intrinsic worth, often measured through accounting metrics such as book-to-market ratios, earnings yields, or cash flow multiples. Value stocks typically possess high book-to-market ratios, whereas growth stocks exhibit lower ratios because investors expect stronger future earnings growth. The topic explains that value premiums may arise because investors require compensation for holding distressed or unpopular securities that often perform poorly during difficult economic periods. Behavioral explanations also suggest that investors frequently overreact to negative information, causing undervaluation that disciplined investors can exploit profitably over time. The topic further explains how macroeconomic factors influence asset returns and risk premiums across financial markets. Economic growth, inflation, interest rates, and volatility all affect expected returns because they shape corporate earnings, discount rates, and investor sentiment. During periods of economic expansion, equities generally outperform bonds because stronger growth improves profitability and investor confidence. Conversely, during recessions, government and investment-grade bonds tend to outperform equities and high-yield securities because investors seek safer assets and more stable cash flows. Inflation also influences asset pricing by affecting purchasing power, monetary policy, and discount rates. As a result, investors continuously adjust portfolios to manage exposure to changing macroeconomic conditions and systematic economic risks. The topic emphasizes that macroeconomic risk factors are critical drivers of both portfolio performance and factor risk premiums. Investors demand compensation for bearing uncertainty associated with economic downturns, rising inflation, or heightened market volatility. Economic growth risk affects equities and credit-sensitive securities because weaker growth often reduces revenues, earnings, and repayment capacity. Inflation risk negatively impacts fixed-income investments by reducing the real value of future cash flows. Volatility risk becomes especially important during financial crises, when uncertainty increases sharply and investors seek safer assets. The framework presented in the topic reinforces the idea that asset returns are fundamentally tied to broader economic environments, and successful portfolio management requires understanding how macroeconomic conditions affect systematic risk exposures across different asset classes. Topic also focuses on volatility risk and methods investors use to manage or mitigate exposure to market uncertainty. Volatility represents fluctuations in asset prices and is often associated with periods of financial stress, investor fear, and declining liquidity. The topic explains two primary approaches to mitigating volatility risk: allocating capital toward lower volatility assets such as government bonds or purchasing explicit volatility protection using derivatives, particularly out-of-the-money put options. While these strategies can reduce downside risk during market crises, they also involve trade-offs, including lower expected returns or higher hedging costs. Managing volatility risk therefore requires balancing protection against losses with a long-term objective of maintaining attractive portfolio performance. The topic also introduces dynamic risk factors and the role they play within multi-factor asset pricing models. Traditional single-factor frameworks such as CAPM are often insufficient because they fail to capture additional systematic drivers of return. The FRM French multi-factor model improves explanatory power by incorporating factors related to firm size and value characteristics alongside the market portfolio. Specifically, the model includes the SMB factor, which captures the size effect, and the HML factor, which captures value versus growth performance differences. These factors help explain persistent return anomalies observed in financial markets. By recognizing that factor sensitivities evolve over time, investors can better understand how changing economic conditions influence portfolio risk and expected returns. Dynamic factor investing also reflects the reality that investor preferences and market conditions constantly change. Factors such as volatility, liquidity, inflation expectations, and momentum can shift significantly during different economic cycles, affecting both asset correlations and portfolio performance. Multi-factor models allow investors to analyze these evolving relationships more effectively than static models. The topic highlights that successful risk management requires identifying how exposures to various factors change over time and how those changes influence portfolio sensitivity. Investors increasingly rely on factor analysis, stress testing, and scenario analysis to evaluate the impact of economic shocks on asset returns. Dynamic factor investing therefore represents an important advancement in modern portfolio management and quantitative investment analysis. Topic also compares value and momentum investment strategies, two of the most widely studied approaches in factor investing. Value investing is described as a stabilizing, negative feedback strategy in which investors buy undervalued securities after prices decline excessively. As prices recover toward intrinsic value, returns improve and market prices stabilize. Momentum investing, however, follows a positive feedback process in which investors purchase securities that have recently appreciated and sell securities experiencing declining prices. Momentum strategies assume that price trends persist because of investor herding, delayed information processing, or behavioral biases. While momentum investing can generate strong short-term returns, it also exposes investors to abrupt reversals and heightened volatility during market transitions. The topic concludes by emphasizing the complementary nature of value and momentum strategies within diversified portfolios. Although value and momentum factors often behave differently during varying market conditions, combining them can improve diversification and reduce overall portfolio risk. Value strategies may outperform during recoveries and periods of mean reversion, while momentum strategies often perform well during strong trending markets. Both strategies challenge traditional market efficiency assumptions by demonstrating that persistent anomalies may exist due to behavioral biases, information frictions, or structural market constraints. Together, value investing, volatility management, dynamic factor analysis, and momentum investing form an integrated framework for understanding modern factor-based portfolio construction and the complex relationships between macroeconomic conditions, investor behavior, and systematic risk premiums.